The best way to buy Treasury notes and bonds at auction right now. That's what we'll be talking about in today's video. Hello, members, super savers, and bond course fans. I hope you're having a good week. In light of the ongoing roller coaster ride in the bond market, this video is specifically for those of you who are 1. Interested in going long, buying some Treasury notes and or bonds either now or in the near future. And 2, prefer to buy your Treasuries at auction rather than on the secondary market like we do. So with that in mind, here are the 3 topics that we'll be covering in today's video. Why is it more complicated to buy T-notes and T-bonds at auction than T-bills in the current environment? Why do we feel dollar cost averaging into auctions is the safest and easiest strategy for buying longer dated Treasuries and getting the best overall yield at the moment? What yields would you have gotten had you dollar cost averaged into the last 10 T-note and T-bond auctions? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Given all the shorter dated T-bills that our Diamond NestEgg community owns, myself included, I think many of you would agree with me when I say buying T-bills at auction has been relatively simple and straightforward so far. We have step-by-step tutorials on this channel that walk you through how to buy T-bills at auction on the different platforms. And those of you who tuned into our channel in our earliest days benefited from rising rates at consecutive auctions. And over the past year, all of us have benefited from basically stable rates when we bought our shorter dated T-bills at auction. Remember, the last time the Fed raised interest rates was a year ago in July 2023, and they have kept the rates stable at these levels ever since, at least for now, at the time of this taping. That's why rates on T-bills have not moved much over the past 12 months, meaning that when you and I have bought T-bills at auction, we know more or less the yield we'll be getting, plus or minus a few basis points. So it can be relatively simple and straightforward when it comes to buying shorter dated T-bills at auction. Buying longer term T-notes and T-bonds at auction can be more complex and less straightforward. Here's why. Reason 1. When you buy at auction, you do not know the price and yield that you will be getting in advance. You just know that it will be the best price and yield at that given point in time based on the then current market expectations and sentiment. As I mentioned earlier, this hasn't really been a problem for T-bill auctions in recent times because rates on the short end have been pretty stable overall. And just a thought experiment for you. If we did know the price and yield before an auction happened, buyers would only buy at the highest yielding auctions. And this would have the effect of pushing those yields down in a market-driven environment where supply is fixed. So that's not a workable scenario either. Moving on to reason number 2. Yields on the medium and long end have not been as stable as short-term T-bill rates. Keep in mind that while the Fed controls rates on the short end quite tightly, they have much less say in what happens on the long end. Plus, it's in the nature of bonds that longer maturities tend to generally react stronger to changes in market conditions. My bond course folks, today's video ties in a lot of what you've learned in our courses. So please refer back to the relevant videos in Bond Beginners on bond price volatility, bond risks, and T-bills, T-notes, and T-bonds as needed for this section of the video. I'll also point you to other relevant course sections as we go through the rest of this video for those of you who might need a refresher. So back to my reason number 2. Rates for longer-term T-notes and T-bonds have been and continue to be very volatile in bond terms, as we talk about so often on this channel, given varying viewpoints on the direction of inflation, unemployment, the presidential election, and so on. And reason 3, if you get a low yield on a T-note or T-bond, you may be stuck with it for years or even decades, not just for a few weeks or months like you would with shorter dated T-bills. In the worst case scenario, you could even have to hold a low yielding T-bond for 30 years until maturity, which is why we feel that dollar cost averaging into auctions is the safest and easiest strategy for buying longer dated treasuries in the current environment and a great segue into the next section of this video. Many of us already dollar cost average when we buy stocks and funds for our portfolio, so the concept should be a familiar one. Dollar cost averaging into T-notes and T-bonds at auction is quite similar to this. So, say that you're interested in the 10-year T-note. Instead of buying this all in one go at one single auction, dollar cost averaging would have you space out your purchases over several auctions. Here's the appeal of dollar cost averaging into T-notes and T-bonds at auction. 1. You know that at every auction you're getting the best price and yield at that given point in time based on the then current market expectations and sentiment. 2. You avoid the risk of buying at any one single bad auction and being stuck with a lower than expected yield for many years to come, because over time the good auctions should smooth out the bad ones and vice versa. 3. You don't have to worry about timing the market or missing out on the best auction, because let's face it, no one can time the market. 4. You don't have to put your money in all at once. You can invest a little bit every month or every quarter. The frequency and timing is entirely up to you, and it may help you build a diversified Treasury portfolio organically over time. 5. You can do this with more than one bond type at a time. So for example, you could dollar cost average into both the 2-year T-note and the 10-year T-note at the same time. Or do the same with the 10-year T-note and the 10-year TIPS, or whatever combination is right for you. Just keep in mind that the more individual bonds you have in your portfolio and the more incremental purchases you're planning, the more time, effort, and money you will need to invest in setting it up, tracking it, and managing it over time. My bond beginners folks, if you're starting to dollar cost average into T-notes and T-bonds or looking for a way to keep track of your bond purchases in general, this T-bill and bond tracker here under important downloads should be a good starting point for you. And my bond masters folks, if you want a refresher on what a dollar cost averaging plan could look like, please refer back to this video here on laddering when rates are uncertain. Now, while I'm generally a fan of dollar cost averaging, there's always the danger that what looks good on a slide or in a video may not always work so well in real life. So, let's take a look at what yields you would have gotten had you followed a dollar cost averaging plan for the most recent T-note and T-bond auctions. In this section of our video, we're going to look at the high yield and interest rate you would have received if you had dollar cost averaged into the 10 most recent auctions across the different T-note and T-bond maturities. Here are the dollar cost averaging results at the time of this taping, assuming you purchased equal amounts in each of the last 10 auctions. This column shows all the T-note and T-bond maturities that the Treasury issues at auction. This column shows the lowest high yield you would have received in the last 10 auctions. And this column shows the highest high yield you would have received in the last 10 auctions. And this column shows the average high yield you would have received across the last 10 auctions. This last column shows the average interest rate you would have received across the last 10 auctions. And as a quick brush up, the high yield is basically the overall return you can expect on your Treasury investment, while the interest rate is the coupon, the regular interest payments you will receive in cash while you hold your T-note or T-bond. Remember that bond prices and yields have an inverse relationship. Again, bond beginners folks, please refer to these videos here if you need a refresher on interest rates, bond prices, and yields, and this one here for a refresher on the auction high yield versus the interest rate. So what this means in the context of this table is that if we were interested in the 2-year T-note, all of us would have loved to purchase all our bonds at this auction here with the highest yield and therefore the lowest price. And none of us would have liked to purchase bonds at this auction here with the lowest yield and therefore the highest price. But we all don't have a crystal ball and can't predict the future. So if we acknowledge this fact and made our purchases by dollar cost averaging into the last 10 auctions, this is the average high yield and the average interest rate we would have ended up with. effectively spreading out our purchase price risk, our yield risk. And these results are pretty good in my mind, especially when you consider the sleep well at night and not having to time the market factors, which I believe are always important considerations for long-term bond investors, but especially so during times of bond market volatility. And fun fact, all of these highest high-yield auctions happened around October of last year when rates peaked. And all of these lowest high-yield auctions happened towards the end of December last year and in January of this year. Meaning that if you had been waiting for rates like these to come around again, or perhaps to go even higher, you might still be sitting on the sideline when it comes to buying longer dated T-notes and T-bonds. And there's nothing wrong with that in my mind, so long as you're okay with the fact that those higher rates may not materialize as you expected, or with the speed that you had expected, like we're okay with it. But I'll save that one for another video. If, on the other hand, you do not want to keep waiting on the sidelines and or you think rates on the long end have peaked or are peaking, then I do believe that dollar cost averaging into auctions is the safest and easiest strategy for buying longer dated treasuries and getting the best overall yield at the moment. So, who's going long now or planning on doing so soon? And who's going to wait it out just a bit more? And if you're waiting, what rate would convince you to start picking up some longer dated T-notes and or T-bonds? Drop a comment below because curious minds want to know. Regardless of which group you're in, I hope you enjoyed this video and learned something new. And if you're ready to dive deeper into everything we've talked about today and how to invest in bonds and build a bond portfolio, do note that our July 4th sale is still up and running. The coupon code SUMMER 2024 is valid through Sunday, July 7th, 2024 at midnight Eastern Time, 9 p.m. Pacific Time. Use it to get 10% off Bond Beginners, Bond Masters, as well as our Bond Course bundle. This is the most popular choice amongst our Diamond NestEgg bond fans at the moment. And yes, that's 10% off on top of this $80 savings when you buy both courses together. Plus, you'll be joining just in time for a second quarter Bond Beginners live online course session on Monday, July 8th at 5:45 p.m. Eastern Time, 2:45 p.m. Pacific Time, where we'll be talking about all things fixed income. Take advantage of bond yields while they're attractive and check out the links below this video for more details on our bond courses. All right, members, super savers, and bond course fans, see you again very soon with more brand new wealth building content for your financial journey.